Hello, I'm Julian Morrison from Allan Gray, and today I'm going to explain a bit about Allan Gray's investment philosophy and how we apply that via the Allan Gray Australia Equity Fund. Now, in today's market, you can buy an exchange-traded fund which holds all the shares in the Australian market for a very cheap price, probably around 0.1%, or indeed you can buy a collection of the shares, maybe the top 10, and you won't pay any management fee. So why would you use an active fund manager and pay them to manage Australian equities for you? In answer to that question, I'm going to talk today about Allan Gray's contrarian investment approach and the potential benefits it could bring. So I'll touch on why the contrarian approach would work and how it might benefit your portfolio. Firstly, one thing we know is that headlines drive sentiment. So here we've used an analogy of the slow queue, the medium queue, and the fast queue. And we know what sort of behaviour that's going to result in. We see it in the supermarket, in swimming lanes, in the airport, at all times. People will always choose the fast queue, but unfortunately for them, they end up standing in a very long queue and facing lots of competition for whatever they're trying to achieve. And generally in life, when you face lots of competition, you're much more likely to get a poor outcome or an average outcome than if you face very little competition. So we're seeking at Allan Gray, in an investing context, to go through the slow and medium queue where we face little competition to buy shares. Looking at investor sentiment at work, here we've got a stylized share price. On the left-hand side at the peak, we can see sentiment is positive. Competition, therefore, to buy the shares is high. That pushes the price up, so the price is high. And in our view, a high price is the surest way to take on risk of overpaying. So risk is high also, and we've highlighted that as the point of maximum financial risk. On the other hand, at the share price trough, sentiment is negative. Competition, therefore, to buy the share is low. This pushes the price down. And typically, when the price is low, we view that as reducing risk, so risk is lower too, and the point of maximum financial opportunity. And that's why we apply this investment philosophy, which we've attempted to stylize here in this diagram. So the thick grey line is our assessment of valuation. We insist on having our own clear assessment of valuation of a company before we will buy one. The wavy black line is the share price, and we're therefore looking for opportunities to buy when the share price has fallen meaningfully below our assessment of value. So we're looking to underpay. We call that a margin of safety. Once we've bought the shares, we'll hold them, and sometimes this may take a number of years until the undervaluation is realized by the broader market. But once that share price starts to rise up and through our assessment of valuation, we'll typically start to sell that share and look for opportunities to rotate the money into another undervalued share. So at all times, we try to maintain a diversified set of contrarian ideas in the portfolio that are at some different stage of this investment life cycle. So to summarize the fund and the key features, we invest in listed Australian shares. We're contrarian in our approach to investing. We avoid the popular areas where we view the risk of overpaying as high, and we look to invest in those areas where sentiment is negative and prices are lower, and therefore we take on less risk. We insist on valuation-based approach, so we value shares ourselves, and will only buy when the price is significantly lower than our assessment of valuation. We're unconstrained in our approach, so we'll invest in shares of all size and all different sectors, and we're willing to exclude sectors entirely if we don't see value there. And because of our investment approach, the contrarian approach, we typically end up with a different set of holdings to many other managers and what people tend to hold themselves, and therefore we can add diversification to most portfolios. Looking at a recent example, or an example over the last few years, Newcrest Mining is shown here. The red line is the share price of Newcrest over the last 10 years, and we can see back in 2011 the headline was extremely positive, that Newcrest was beating production forecasts and the situation was improving. But that was the point of maximum financial risk. The price was above $40, and subsequently it fell down to around $7. At that point, the headline became extremely negative. We can see there the Australian newspaper said, $5.8 billion loss rocks Newcrest. But that referred to the past, not the future of the company. And at that point, we assessed long-term future valuation was much more attractive versus the price than the market anticipated. So we started to buy, and the grey shaded area shows how many shares we held in Newcrest over time. And you can see we built the position, And on the more recent spike in the share price, we've started to reduce that position significantly, and subsequent to this chart being produced, we've reduced the position further. So where else are we investing today? In the current market, the market's near all-time highs, and it's been driven upwards by some very strong and very popular areas such as healthcare. Here we've shown the healthcare sector in black. That's the relative performance of the sector versus the broad market over 10 years. And we've also shown the relative performance of energy, which is the worst performing sector over the last 10 years. And we've overlaid this graph with quotes from two stock market greats, Warren Buffett and Howard Marks. So Warren Buffett said, "You pay a very high price in the share market for a cheery consensus." And we've aligned that with the best performing sector, which is healthcare, where we think the risk of overpaying is greatest. And another investor, Howard Marks, said, "Most great investments begin with an element of discomfort." And we've aligned that with the energy sector, which has performed most poorly over the last 10 years, but that is where we see the greatest opportunity. So if we look at the sectors in the Australian market, we can see from left to right, worst performing has been energy over 10 years, and the best performing on the right-hand side has been healthcare. It's perhaps not surprising, given how we've explained our investment philosophy, that our biggest position is in energy stocks. And we have a significant underweight to healthcare stocks on the right-hand side. We tend to own those shares which have underperformed, where we see the risk of overpaying as reduced and the best opportunity going forwards. So how do we help investors? We believe we help investors avoid the herd. So here we've looked at the 5 biggest, most popular fund managers in Australia, active managers, and they're shown, or their top 10 holdings aggregated are shown by the grey bars on the left-hand side. Alongside that, we've shown the weight of those shares in the ASX 300 index, and we can see that they're very similar. Allan Gray's holdings in those shares are shown in red, so you can see we hold much less than those popular managers in the top 10. And on the right-hand side, we've shown what is held outside of those top 10 shares, and we can see that the 5 most popular managers hold very similar amount outside of the top 10 to the index, the black and the grey bars, whereas Allan Gray holds a far greater amount outside of the index at around 90% of the fund. So we bring something very different for investors to their portfolio versus other funds that they might own. In terms of performance, over the last 10 years and 5 years, you can see here Allan Gray in red, net of fees, has outperformed all of those 5 largest fund managers, and also has outperformed the index, which is shown in blue. Putting that another way, in a line graph, here we show net of fees. Allan Gray's performance since inception is the red line, the grey line is the ASX 300 index, and the black line is the Small Ordinaries index. And we've shown that because we're an all-cap fund, so we're able to invest in mid and small shares also, so this provides some extra context. The performance is shown here in the table to give you some numbers over 1, 3, 5, 10 years and since inception. So you can see we've outperformed over the long term, as we've noted, but it is also worth noting we've underperformed over the last year. That happens from time to time if you're positioned differently, but we're quite happy as investors in our own funds with a return of over 12% over the last year. The market's done a lot better, but that's in an environment where the market's been driven by these popular shares and is near all-time highs, and we believe carries a lot of risk. So we're happy to be positioned differently in this situation. And typically, periods of underperformance for us historically have been good times to invest for subsequent future performance. So just to finish off now, how may a contrarian approach benefit your portfolio? Firstly, we bring the potential for outperformance. As we've shown, at least historically, we've delivered outperformance after fees for our clients. We're positioned very different to the benchmark. That's required to deliver outperformance, but it also means we bring diversification to your existing portfolio. Also, in terms of risk, contrarian investing, counter to common thinking, actually seeks to reduce risk. We want to reduce the risk of overpaying and seek to underpay instead. And today, in a market that's near all-time highs, driven by some very expensive sectors, we think this is as important as ever. So going back to that analogy, we think contrarian investing benefits investors by helping them to avoid the herd and avoid facing lots of competition and standing in a very big queue to buy popular shares. We want to seek opportunities to go through the slow and medium queue. So we hope that's been a good introduction to Allan Gray. If you'd like any other information, please visit our website, allangray.com.au, or you can fill in your details on the Livewire website. Thanks very much.